Hello everyone, welcome to video 5 of the first module in which we'll be discussing hedging and correlation. Now these two topics are very crucial in your understanding of how the market works, but to say the least, it can really give you an additional advantage in your own trading to help you with your profitability when it comes to your profit from accounts. So I'm going to briefly describe what the two mean and get into some examples to give you a clearer representation of what I'm talking about. So hedging is essentially doing the opposite of what you originally did before. So for instance, Euro USD, if I were to sell this, I could also buy it. That is hedging. So that means if the Euro USD short goes long, I could also buy it. And if it continues to go long, I'm winning and losing on one position. So I'm trying to minimize my losses. Now, that doesn't mean that you should just buy and sell everything that you trade. That's just probably not a smart thing to do. But it can definitely help to eliminate risk if your trade gets into further loss. So if I were to buy this and it really just goes short, I could also sell it. So I'm in a buy and a sell. That's hedging one position over the other. I'm doing the exact opposite of what I did before. So that can help minimize risk, but it has to be done strategically. And there's many ways in which we can hedge, many different trading plans that people can use in order to hedge effectively. There's no right or wrong answer, but that is essentially what hedging is. It is doing the opposite of what you originally did. And hedging doesn't always have to be on one pair, meaning currency pair. You can hedge with different currency pairs. So when it comes down to correlation, and both of them tie together pretty well, correlation is essentially when we have, let's just say, one asset class and how that impacts a different asset class. Does it impact it in a positive way or a negative way? Meaning if Euro USD goes short, what does that do to something like GBP USD? Well, GBP USD and Euro USD are correlated. They're positively correlated, meaning if one does one thing, the other will do the same. If we're looking at Euro USD and USD CAD, those two are inversely correlated, meaning if one does one thing, the other will do the opposite. So if Euro USD is pushing down, GBP USD, because it's positively correlated, will also push down. If Euro USD is pushing down, USD CAD, or like USD JPY, for an example, would push up. And the reason is because if we take Euro USD and GBP USD and it goes short, both are experiencing dollar strength. One will do the same as the other. But if we have USD CAD and Euro USD and we're seeing dollar strength, Euro USD would push down, but USD CAD would push higher because it's where the currency is in the sequence. USD would go here, CAD would go here, but in this case, Euro goes here and USD goes here, if that makes sense. You kind of follow what I'm saying. So that is what the correlation is. So typically, when we're experiencing something like, correlation doesn't have to be always with currency pairs. It can be with indices. It can be with metals. So let's just take gold, for instance. If gold is pushing higher, we're experiencing the gold strengthening over the dollar or the dollar weakening over gold, meaning the gold is becoming more valuable. So if that is the case, what would likely happen if we were to see a AUD USD chart? Well, if gold is pushing higher, AUD USD would likely also push higher to see that US dollar weakness. If gold is pushing down, AUD USD would likely also push down. Now, that doesn't mean it's going to do the same thing pip for pip. It could be a little bit different in its market structure and what it's doing because technically they are not 100% correlated. Because if we're taking gold and AUD USD, even though those are positively correlated pairs, if one does one thing like shorts off, the other will also likely do the other thing, short off, right? So, but we're looking at not necessarily just the US dollar because we have gold with USD and obviously AUD USD with USD here. We also have the Aussie and gold itself. So that we have many different factors, but likely everything that is correlated will have some sort of movement alongside other correlated pairs, but it's not going to be one for one, meaning every single pip AUD USD pushes down, gold will push down. That doesn't mean that's going to happen. We can see differences, but the overall market structure will relatively be the same. All right, so that's kind of how we can use correlation to predict future prices. Let's just say that we have a potential setup on AUD USD, right? And let's just say Euro USD is completely mooning. It's pushing up and it's just going long. If we have a setup on AUD USD for a potential long opportunity, that could provide further confluence to take that trade because we're using correlation to predict future price. If Euro USD is just skyrocketing and we're looking at AUD USD, which is positively correlated with Euro USD, and we're doing our analysis and we're seeing a lot of confluence and a setup to go long, well, we already know Euro USD is pushing up, then that just gives us further conviction that AUD USD will also follow suit as well. Now with hedging, what we could do here is if we're talking about, let's just say currency pairs, if AUD USD is pushing down and we have a potential USD CAD short opportunity, then we could potentially take that as a hedge. Now, remember what I said before. Remember, if we have AUD USD and AUD USD is pushing down, what would USD CAD likely do? Push up, right? That would be the case. However, if AUD USD is pushing down and we have a potential, let's just say USD CAD short opportunity, that could be called a hedge because you're going against the two pairs. Because typically AUD USD, if that's going short, USD CAD is likely going long. That's how it works, right? Typically. But if you have a USD CAD short opportunity and you're in like a AUD USD short, that could be a hedge. Because let's just say AUD USD does go short and you're making money on that trade, then you'd probably be losing money on your USD CAD trade potentially, but at least you're not double exposed. Double exposed meaning you're not buying USD CAD in a sense of if AUD USD were to go up, then USD CAD were to drop, now you're losing on both trades. But instead you're only losing on one if you sell AUD USD and USD CAD. You can sell or buy inversely correlated pairs because one will likely be in profit, the other at a loss. But the thing is with setups is that if you get a USD CAD short opportunity and it does go short, then you're making money on that one. And then AUD USD would likely push back up, right? So to make matters very simple, hedging is just doing the opposite of what you originally did on a current currency pair like AUD USD. You can buy and sell, that's a hedge. Or you can use that with correlation and hedge that way. If you currently are in an AUD USD short, but you also look at USD CAD, which is inversely correlated, it will likely do the opposite. It will likely push up if AUD USD is pushing down. But let's just say you have a USD CAD short opportunity, then you could take that opportunity and hedge that with your AUD USD short that you're already in. And that could be smart because one would likely win, one would likely lose, right? But it's smart because if you were in an AUD USD short but then a USD CAD long, you could be double exposed to the USD to where if USD actually weakened and AUD USD pushed up and USD CAD pushed down, now you're in a double loss because you lost both of those trades. So it just helps to minimize risk across the board with your overall trading. So it's really self-explanatory. You can learn more about hedging and correlation if you go to babypips.com. Babypips.com definitely gives just general overviews and broad explanations of just very simple topics when it comes to trading. So it doesn't need to be very in-depth when it comes down to understanding what exactly hedging or correlation really truly means and how we can nitpick every little thing. We don't need to be doing that in our trading. We just need to have an overall idea of what it is and kind of how we can use that within our own trading plan moving forward. So that is what hedging and correlation